All right, let's dive into Olin Corporation. Now, I know what you might be thinking, an industrial heavyweight that's over a century old? But trust me, this is no history lesson. This is an investment memo about a company that basically tore up its own rulebook. And the results? Well, they were pretty explosive.
Olin has been around for what feels like forever, a real pillar of the American industrial economy. But if you look a little closer, you'll find this incredible, dramatic reinvention that has completely changed the game for them. So the big question is this old dog learning some very profitable new tricks?
So to really get why this turnaround is such a big deal, we've got to rewind the clock a bit and look at the old playbook Olin was using. The one that almost ran it straight into the ground.
It all kicked off way back in 1892. Believe it or not, they started as a blasting powder company for coal mines. From there, Olin just grew and grew into this massive producer of essential chemicals and eventually became the owner of the iconic Winchester ammunition brand. We're talking about a true American legacy company here.
For decades, Olin did what pretty much every commodity producer did. The goal was super simple: make as much stuff as you can, sell it, and then just hang on for the wild ride of the global economic cycle. And this, of course, led to that classic boom and bust pattern that was, you can imagine, just incredibly frustrating for investors.
But then, right around 2020, something fundamental shifted. It's like Olin decided to stop being a passenger on that crazy roller coaster and instead try to grab the controls for itself. And that one single decision, well, it changed everything.
Okay, so what does Olin actually do today? The company is this fascinating mix of two really different worlds, and seeing how they fit together is totally key to understanding their whole strategy. So, looking at this, the chemical business is clearly the heart of the company. You've got chlor-alkali, vinyls, and epoxies making up almost 80% of Olin's sales, but see that other 22%? That's the famous Winchester ammunition business, and it plays an incredibly important role.
And this is where the business mix gets so clever. The chemical side is super cyclical. It soars when the economy's booming, but it gets hammered in a downturn. Winchester, on the other hand, is the steady anchor. It provides this reliable stream of cash that acts like a buffer, smoothing everything out no matter what the rest of the economy is doing.
Now, to really understand the chemical business, you just have to know about the ECU. It's their basic unit of production. See, for every ton of chlorine Olin makes, it automatically produces 1.1 tons of caustic soda. They're basically chemical twins. And here's the kicker. Olin is the biggest producer of this stuff on the entire planet.
Okay, this is where the story gets really good. We're about to look at the exact moment Olin's entire strategy got flipped completely on its head.
So, picture this. It starts in 2015 with a huge merger that doubles the company's size but also piles on the debt. Fast forward to 2019, a downturn hits, earnings just collapse, and the stock is in the tank. This was the perfect opening for an activist investor who came in, pushed for change, and that led to a new CEO and, in 2021, a radical new strategy they called the winning model.
The new plan was just brilliantly simple. Stop chasing volume at all costs. It's like they decided to stop being a discount warehouse and start acting like a luxury boutique. So instead of flooding the market and crushing prices, Olin would now proactively cut production to keep supply tight and support higher profit margins. For the commodity chemical industry, this was a revolutionary idea.
A radical strategy sounds great on paper, right? But did it actually work? Well, the numbers really do tell the story.
Get this. In 2021, the very first full year of this new strategy, Olin delivered a staggering $2.5 billion in EBITDA. This wasn't just a small bump, it was an absolute record smasher. For a company that had seen its earnings collapse just 2 years before, this proved the winning model wasn't just working, it was a total grand slam.
And this chart right here, this shows the most important outcome of all. Before this whole new strategy, Olin's peak profit margin was maybe 15%. Now look at 2023. In the middle of a nasty industry downturn, its margin was 18%. Think about that. Their worst days now look better than their best days used to. This is proof that the company's profitability is now structurally, fundamentally higher,
And they put all that newfound profit to spectacular use. First, they totally transformed the balance sheet, paying down a ton of debt, which earned them a solid investment-grade credit rating. And for investors, they returned a massive $4 billion to shareholders and bought back over a third of the entire company's stock. It was just a remarkable financial transformation in a few short years.
So, after all that, what's the final verdict? Is Olin today a coiled spring just sitting there waiting for the economy to turn so it can rocket higher?
Well, the bull case is pretty clear. When the industrial cycle eventually recovers, Olin's earnings could absolutely explode higher, and all those share buybacks will make the per-share numbers look even better. The risk, of course, is that chemical markets are still brutally cyclical. A deep, long recession would definitely hurt, no matter how good the strategy is.
Ultimately, the whole investment thesis comes down to this idea of a coiled spring. The company has immense potential to generate massive earnings when the economy cooperates. But, and this is crucial, its newfound discipline and shareholder-friendly actions provide a really strong cushion on the downside. And that leaves us with the really big question, right? Has Olin truly changed the game for good, creating a more resilient, more profitable company, no matter what the cycle does? Or will those old boom and bust dynamics eventually come back to bite? The answer to that is what will determine if this 130-year-old company's best days are still ahead.